In today's video, I am going to be breaking down my top 6 favorite banks in Canada. Obviously, it's the top 6 banks in Canada, but the best of those top 6. Let's get down, let's check them out, let's see which one's the cheapest, which one may be the best for future growth, and of course, let's just see which one's best right now. Okay, so first we're going to look at Bank of Nova Scotia and see what the PE ratio is. I really do like to, of course, look at the PE ratio and see which bank is actually cheapest first. So when it comes to Bank of Nova Scotia, the PE ratio is 10.9. When we move down to National Bank, we can see the PE ratio is 12.07. And then we can move over to the TD Bank, and we can see that, of course, the PE ratio on TD is 9.72. And then we look at Royal Bank of Canada, and the Royal Bank of Canada's 12.2. Moving over to CIBC, the PE ratio is 11.14, and the PE ratio of Bank of Montreal is 11.9. Now, when I start looking at each one of these individual names, the PE ratio seems to be the lowest when we start looking at TD Bank. So right off the bat, TD Bank is winning my bet as to being the best bank to buy right now. However, it's not just PE ratio that we look at, or what I look at. When it comes to the Canadian banks, in my opinion, when it comes to PE ratio, anything below 10 is extremely cheap. Anything between 10 and 11 is a good buy, and anything above 11, like let's say 11 to 12, is kind of there might be a pullback coming soon, because that's essentially how the Canadian banks work over the past couple of years anyways. But basically, when we start looking at the PE ratio above 11 to 12, it's like almost like a, hey, if it's got a good dividend, buy it kind of thing, but it could be having a pullback coming soon. Meanwhile, anything over 12 is like stay away unless there's something crazy happening, like crazy growth that we just recently seen with a lot of the banks. So let's actually look at TD Bank first. So when it comes to TD Bank, yes, it does have a lower PE ratio. It also has great volume, and over the past year, and I'm going to say that this could be a very good distance to really read, is it's had a pretty strong growth. Of course, we had that pandemic low, we've also had the pandemic high, and we've had a little bit of a pullback since that high. The next cheapest is, right now, Bank of Nova Scotia, and its chart is actually very similar. We've had that pandemic low, we've had that pandemic high, and now it's pulled back just slightly. Its PE ratio is a bit higher at 10.9, and at that point, it's also got a higher dividend percentage of 4.6 versus TD that was 3.8. So if you're looking at a higher dividend, then at that point, if you're looking for the cheapest banks, then at the cheapest bank with the highest dividend would be the Bank of Nova Scotia. And the Bank of Nova Scotia has been a bank, when it comes to the stock charts, that's been slightly hated over the past 3 to 5 years. Now, when it comes to Scotiabank, it's one of those banks that you either hate it or you like it. So if you bank with it, you tend to hate it in most cases because they're always just so slow at responding to your issues. There's a lot of complaints that go into Bank of Nova Scotia. However, they do extremely well when it comes to the stock market in most cases, especially if you're looking for slightly slower growth, at least over the past couple of years, but a higher dividend. The CEO of Scotiabank back during the pandemic said that his stock was extremely cheap after it had that big massive run. And the CEO also said that they're looking to substantially increase their dividends once they're allowed. Now, I would assume that all bank CEOs are going to be substantially increasing their dividends anyways, because they haven't been allowed to, because, of course, the activist groups that are telling them not to. The two next cheapest would be CIBC as well as Bank of Montreal. Now, Bank of Montreal has had a ridiculous growth since its pandemic low. It's actually one of my highest performing bank stocks over the past year. Its PE ratio is 11.9, while CIBC is 11.1. I actually personally have more shares of CIBC than I do of Bank of Montreal, and the reason is because the dividend is a bit higher, and I personally prefer higher dividend stocks. However, Bank of Montreal has been making a killing when it comes to just making money. And of course, they're getting more and more into the States as well, same as TD, and they've been having a lot of success recently down in the States. So because of that, I would actually lean towards Bank of Montreal. However, with CIBC, what you're getting is a bank that historically doesn't just raise dividends once per year, but at one point they were raising dividends twice and even 4 times a year. So because of that, I really do like their dividend strategy, both of which have millions of shares being traded every single day, so they're very easy to get in and out of. However, when it comes to dividend, it's kind of a nice way to get a dividend of 4%. However, at 3.3%, both of these banks are going to be raising dividends soon, and once they do next year, it'll be interesting who has the larger dividend out of those two. The next one is the National Bank of Canada. Now, while other banks tend to trade sideways over the past 5 years, not including the pandemic, National Bank was actually growing their stock price through that time. Now, the thing with the National Bank of Canada, National Bank of Canada, NA on the stock market, is their dividend is much lower, but it's because they've had much higher growth when it comes to their stock price. Now, is this good that their dividend is lower? Well, it's going to be really keeping eyes off of National Bank, who are wanting to buy it for the dividend. However, their stock price and their earnings are just absolutely amazing. They were, again, one of the banks that were growing during the last couple of years, where most of the other banks were just basically trading sideways. So the National Bank of Canada might be an interesting choice if you wanted to have a higher growth bank. Now, of course, whatever happens in the past is not guaranteed to happen in the future. However, you can basically own all 6 of these banks and do extremely well. Now, the PE ratio is 12.07, which is kind of like that warning zone in my eyes. However, this is a nice steady chart. If we compare their chart versus all of the other banks, which bank would you rather own out of them all? Would you like a bank that had massive growth and is now stabilizing? Would you rather have a bank that continued to stay low but is now trading sideways? Or would you like to have another bank that has had massive growth like BMO? Or you can have TD that's had massive growth but now stabilizing? Or would you like to have steady growth since the pandemic lows? I would personally be favoring Bank of Montreal, Royal Bank of Canada, and National Bank as well. However, this is also why their PE ratios are much higher than the others. One thing that you're actually going to notice with the Canadian banks is for a couple of years, usually a 1, 2, or 3 year period, there's going to be 2 or 3 that are just not favored and they've got lower PE ratios. And then somehow it flip-flops so that the others that were the other 2 or 3 that were being favored before are going to be not so favored, and they tend to flip-flop. Sometimes it's every 2 or 3 years, other times it's 5 or 7 years. But if you're in this for the long term, if you're a dividend investor, generally you're a long-term investor, then you could essentially buy the ones that have the cheaper PE ratios, go through kind of like that stumbling period, and then have massive growth. And then, on the flip side, 3, 4 years from now, buy the other ones that now have that lower PE ratio. But we have to remember that we could just buy all of them at the same time. Wait for the monthly pullbacks, because, of course, the stock market tends to pull back once a month. And wait for the once a month 2 or 3 or 3.5% pullback, and then buy in then. And then wait till next month and then buy in again when there's that 2% pullback again. You'll notice that the stocks tend to do that every month or two. So I hope that you've enjoyed today's video. If you have, hit that like button and subscribe, and I'll see you guys again next time.